Hello, everybody. My name is Alash Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending September 16th, 2022. But before we go into that, I'm trying out something new. Instead of using the green screen, this is the natural office. I know people who follow me on TikTok are saying, yeah, we've been looking at this for 2 years, but for YouTube folks, it's new. So let me know in the comments whether you like it or hate it. I'll try it for a couple of videos, see what happens, but this is without me having to set up the green screen and being able to wear a green shirt. So, turning to the markets, all of the market indexes that I follow, gold and oil, were all lower in a tough week. All the movements in the markets are about inflation and the central banks increasing interest rates to combat that inflation. Canada shed jobs for the third month in a row in August, and the unemployment rate jumped to 5.4%. And Canada lost nearly 40,000 jobs in August. This is a potential signal that the interest rate hikes have started to cool the tight labor market, which is what Bank of Canada is trying to do. The Canadian credit card debt is the highest it's been since 2019 and is up 8% in June from the year before. The falling real estate and stocks have caused net worths to plummet, and Canadians are spending less. Canadians are also very sensitive to interest rates because of their debts. Around the world, soaring borrowing costs are squeezing homebuyers and property owners alike. The Bank of Canada is checking on how the interest increases affect the economy and Canadian spending. The Canadian real estate continues to decline, down about 7.5% from the peak, with the expectation of further decreases. The real estate market and the banks haven't even priced in fully the interest rate increases into their prices yet, and the expectation of a 20% drop from the peak is expected. Canadians may feel poorer, and this will filter into consumer spending. Places that have had a big run up drop the most, and those that hadn't gone up a large amount may even have small gains. The reports of the demise of inflation in the US have been greatly exaggerated. The US inflation turned out stronger than expected yet again in August, paving the way for another big hike in interest rates from the Federal Reserve when its policymakers meet next week. The Consumer Price Index rose 0.1% in August month over month and was up 8.3% from a year earlier, the Bureau of Labor Statistics in the US said on Tuesday. The expected reading was 8.1%, and the analysts had expected prices to fall by 0.1%, thanks to the steady decline in gasoline prices from their summer peak. And when this didn't happen, markets sold off. The previous month's year-over-year reading was 8.5% inflation, so it was down, but not as much as expected. However, that factor was overwhelmed by big increases in the less volatile elements of consumer spending. The so-called quote-unquote core CPI rose a thumping 0.6% because it does not count the lower gasoline prices, twice what was expected, driving the annual core inflation rate up to 6.3% from 5.9% in July. That's the highest it's been since the 40-year high that it hit in March. The Nasdaq Composite was the worst hit on Tuesday, falling more than 5% as large tech names like Meta, Nvidia, and Netflix got crushed. Just 5 stocks in the S&P 500 finished in positive territory on Tuesday when the CPI numbers were announced. The Dow had the worst day since June of 2020. The bond market prepared to price in more Fed rate hikes as well. The US bond market did sell off as well on the bad inflation news, raising the yields and thus the fixed rate mortgage interest rates all the way up to 6.28 for the 30-year on Tuesday in the US, about double what they were at the start of 2022, which is significant. US real estate market is slowing as well, with existing owners having to leave a mortgage that was half the rate. The rental market is softening as a result. The core inflation, where the housing costs are a large component, is stubbornly sticky because while the interest rate hikes are having an impact, it takes months for the hikes to actually affect some of the slower moving parts of the economy like real estate, rents, and work their way through the system. The headline inflation will come down on both sides of the border because of the lower gasoline prices, but core inflation will remain. Peak inflation has already happened, according to most experts. For next week, the US Fed now has a 1% rate hike as a possibility, while it wasn't a possibility prior to this consumer price index reading. A three-quarter% hike is almost guaranteed. Experts think both sides of the border will stop raising, with the overnight rate somewhere around 4 to 4.5%. Midweek, the US bond market is pricing in a 4.3% final interest rate. The 2-year bond is yielding more than the 10-year bond, inverting the yield curve in the US and possibly signaling a recession again. Keep in mind that monetary policy takes anywhere from 6 to 9 months through to 12 to 18 months, depending on who you talk to impact the economy and slow demand, thereby inflation. The CPI is a trailing indicator going back 1 year, meaning the CPI is still showing as hot inflation, but the current reality in the economy is that real estate rents and the Canadian job markets look very slow because the central banks hit it hard with a blunt instrument of interest rates. In the US, FedEx warned on earnings, meaning their Q3 report may be lower than previously expected. FedEx is a delivery company and a bellwether for the US consumer and economy, so this may mean things are slowing. They mentioned a general economic slowdown and the after pandemic spending and the buying petering off. There are some Q3 earning warnings and updates coming down from American companies. This is bad news as the earnings season approaches, but it is still a few months out. The Bank of Canada's terminal rate is now the expected 4.5%, up from 4.25%, as I had mentioned, after the CPI reading in the US, even though some opinions are still in the threes. Producer prices in the US fell 0.1% in August, in line with expectations, so that is good news in the US markets. In Europe, with the energy flow from Russia being shut off and energy prices sky high, it is looking like alternative energy sources will be hard to come by, and it will be a cold and expensive winter in Europe. A recession in Europe is a foregone conclusion. The US will stop drawing oil from the Strategic Oil Reserve in November, which will further lower inventories and raise prices. The Canadian dollar is strong against other currencies because of oil. We're a petrocurrency, but weak against the very strong US dollar because the USD is a reserve currency, and when people are afraid, they buy the US dollar. Turning to next week, companies reporting next week on Wednesday, we have Lennar, which is a US home builder, which will give an idea of the state of the US real estate. Thursday is Costco and Accenture, a retailer and a consulting company, showing us how people and companies respectively are spending. Turning to economics events next week, on Tuesday, Canada has its consumer price index reading for August, with a 7.3 year-over-year expected. On Wednesday is the US Fed interest rate announcement, as I had mentioned, and a press conference. A 3/4% rate hike is expected, with a 1% being a possibility. Friday, the US Fed Chairman Powell has a press conference. So that concludes my thoughts for the week. Please let me know what you think about the natural background in the comments. If you have any requests on what you'd like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.